Good Deed Limited is engaged in the business of recycling of waste from dumping grounds of Municipal Corporation of Indore to usable manure. It is in this way also helping them make the city clean. During the course of audit by Zoha and Zoha, a firm of auditors, it is observed that a company has received notice from Central Bench of National Green Tribunal for not following environmental regulations involving imposition of hefty monetary penalty on the company. Company is yet to reply to the notice. Auditors point out that same is not stated in the notes to accounts in the financial statement. The company point out that auditors are going beyond the scope of their work. Does such a matter fall within the scope of audit? Does it fall in the scope of audit? That's the thing here. So, auditor are asking to mention in the notes to accounts. They say you are going out of your way. You are violating the environmental violation. You're going beyond the scope of the audit. Now, scope refers to range or reach of something. When we talk about scope, it is a range or reach of something. The purpose of audit is to enhance the confidence, degree of confidence of the intended user in the financial statement. So, any audit you're doing, your objective is to enhance the confidence or degree of confidence of the intended user. That's what it is actually here. Okay. So the user of financial statement may be shareholder, employee, customer, government, regulatory authorities, bankers. Now, enhancing of degree of confidence is achieved by expression of opinion whether financial statement in all material respect are prepared as per the applicable financial reporting framework. You have to state that have you prepared the financial statement as per applicable financial reporting framework. The following points are included in the scope of audit of financial statement: coverage of all aspects of entity. The audit of financial statement should be organized adequately to cover all aspects of the entity relevant to the financial statement being audited. Reliability and sufficiency of financial information. The auditor should be reasonably be satisfied that the information contained in the underlying accounting records and source data like bills, vouchers, and documents is reliable and sufficient basis for preparation of financial statement. The auditor makes a judgment as to reliability and sufficiency of information by study and assessment of accounting system and internal control, whether it is appropriate based on inquiries and applying other procedures. Then there should is there a proper disclosure of financial information. Auditor should decide whether all the relevant informations are properly disclosed in the financial statement. You should also keep in mind the applicable statutory requirement. That's the thing here. So whether the transactions are financial statement properly summarize the transaction and events recorded in the by considering the judgment made by the management. Management is responsible for preparation and presentation of financial statement and makes judgment in preparing and presenting the financial statement. The auditor, what he does, he evaluates the accounting policy which has been followed. That's the thing here. So now, whether there is a proper selection and application of accounting policy. Financial statement are prepared on historical financial information basis. Now, what is historical financial information? It is a financial term derived primarily for the accounting system about the economic events, about the economic conditions of the economic conditions or circumstances based on the time actually. Okay, that is what we understand by the financial events. So now in this case, what has happened? The entity is making a complete disclosure. There is a complete disclosure actually. They are highlighting, they are making a complete disclosure of the same. So here in this question, what has happened? The company is telling that will it fall in the scope of the audit? Yes, because this will lead to either provision or contingent liability. What does the AS 29 states about contingency provisions, contingencies, and contingent assets? It states very clearly that if an asset, if any, like say the entity, the possibility of, like say the payment or losing the case is very high, then they have to create what you can say they need to create a provisions. But suppose say they are going to lose the case or the possibility of outflow is very bleak, then you have to at least create a contingent liability. So it may or may not arise. We are not sure about it. So this will definitely have an impact, and company has to disclose this. This will have an impact on the intended user. This is a significant matter. So here definitely it falls in the scope of the audit. So scope of audit, finally, one, coverage of all aspects of the entity which are relevant to financial statement, relevance, reliability and sufficiency of financial information, proper disclosure of the financial information. Is it completely properly disclosed or not? That you have to check as a auditor.